Inflation is an economic phenomenon that erodes the purchasing power of money over time. When inflation rises, each unit of currency buys fewer goods and services, undermining your ability to maintain your standard of living and to preserve your wealth. For individuals and families, inflation can feel like a hidden tax, silently chipping away at savings, investments, and income. Understanding how to protect your money from inflation is crucial for financial security, especially during periods of high or unpredictable price increases. While inflation is a complex macroeconomic force influenced by a myriad of factors, such as central bank policies, supply chain disruptions, and global events, there are practical, actionable steps you can take to shield your finances and even benefit from inflationary environments. To begin, it's important to grasp the nature of inflation and its impact on various asset classes. Not all assets are affected equally by inflation. Some lose value, while others tend to appreciate or at least retain their real value. Cash, for example, is the most vulnerable. Money kept in a checking or savings account typically earns interest rates well below the rate of inflation, resulting in a gradual loss of purchasing power. If inflation is running at 5% per year and your bank account yields only 1%, you're effectively losing 4% of your money's value annually. Over a decade, this compounding effect can be devastating. One of the most straightforward ways to protect your money from inflation is to invest in assets that have historically outpaced inflation. Equities, or stocks, are a prime example. Companies can often pass increased costs onto consumers, allowing their revenues and earnings to grow with or ahead of inflation. As a result, stock prices tend to rise over the long term, providing returns that usually exceed inflation. However, not all stocks are created equal. Companies with strong pricing power, such as those in essential sectors like consumer staples, healthcare, and utilities, are generally better positioned to withstand inflationary pressures. Conversely, companies with thin profit margins or heavy reliance on fixed-price contracts may struggle when costs rise. Diversification within your stock portfolio is also vital. Investing across different sectors and geographic regions can help reduce risk and capture growth opportunities wherever they arise. Exchange-traded funds, ETFs, and mutual funds offer easy ways to achieve broad diversification, and many are designed specifically to hedge against inflation by focusing on sectors that benefit from rising prices, such as energy, materials, and real estate. Speaking of real estate, property ownership has long been considered an effective hedge against inflation. Real estate values and rents tend to rise along with the general price level, preserving and sometimes increasing the real value of your investment. Residential properties can generate rental income that adjusts with inflation, while commercial real estate often features lease agreements tied to inflation indices. Additionally, real estate is a tangible asset, which means it cannot be devalued by monetary policy decisions in the same way as fiat currency. However, real estate investing requires careful consideration of location, market conditions, and ongoing management responsibilities. Real estate investment trusts, REITs, provide an alternative for those seeking exposure to property markets without the complexities of direct ownership. Another traditional inflation hedge is commodities. Commodities include raw materials such as gold, silver, oil, agricultural products, and industrial metals. Historically, these physical assets have maintained or increased their value during periods of rising inflation. Gold, in particular, is often seen as a safe haven during times of economic uncertainty and currency debasement. While commodities can be volatile and do not generate income, allocating a portion of your portfolio to commodities can provide useful diversification and protection against inflation shocks. Inflation-protected securities are another important tool. In the United States, Treasury inflation-protected securities, TIPS, are government bonds specifically designed to safeguard investors from inflation. The principal value of TIPS is adjusted based on changes in the Consumer Price Index, CPI, ensuring that both the principal and the interest payments keep pace with inflation. Many other countries offer similar instruments. Including inflation-protected bonds in your fixed income allocation can help preserve the real value of your capital. Beyond these traditional asset classes, there are other strategies for mitigating the impact of inflation. One is to reduce exposure to long-term fixed-rate debt instruments, such as standard government or corporate bonds. These securities pay a fixed interest rate, which becomes less valuable as inflation rises. Shorter duration bonds or floating rate notes, which adjust their payouts in response to changing interest rates, are less vulnerable to inflation risk. On the liability side, inflation can actually work in your favor if you have fixed rate debt, such as a mortgage. As the value of money declines, the real burden of your fixed monthly payments decreases, making it easier to repay the loan with cheaper dollars. This dynamic can be advantageous, provided you have locked in a low interest rate and can comfortably manage the payments. It's also wise to consider the impact of inflation on your income streams. Wage earners should seek employment opportunities or negotiate compensation packages that include cost of living adjustments, COLAs, or performance bonuses that reflect inflationary trends. Developing new skills and maintaining career flexibility can also help you stay competitive in a changing job market. For retirees, selecting pension plans or annuities with inflation adjustment features is crucial to maintaining purchasing power throughout retirement. Another key aspect of inflation protection is prudent budgeting and spending. During inflationary periods, prices for goods and services can rise unevenly. Tracking your expenses and identifying areas where costs are increasing can help you make informed decisions about where to cut back or substitute alternatives. Bulk buying of non-perishable essentials, taking advantage of discounts, and avoiding unnecessary purchases can help stretch your budget further. Investing in yourself is another powerful strategy. Education, skills development, and health maintenance can yield returns that far outpace inflation. By increasing your earning potential, you are better positioned to absorb higher costs and take advantage of new opportunities that arise in dynamic economic environments. Tax planning also plays a significant role in protecting your money from inflation. Inflation can push you into higher tax brackets, a phenomenon known as bracket creep, or erode the real value of deductions and credits. Utilizing tax-advantaged accounts such as 401ks, IRAs, HSAs, and other retirement or investment vehicles can help shield your returns from taxes and enhance the compounding effect of your investments. Consulting with a tax advisor to optimize your strategy based on current laws and your personal circumstances is always advisable. It's important to recognize that no single approach offers complete protection from inflation. The best defense is a well-diversified, flexible financial plan that can adapt to changing conditions. Regularly reviewing your portfolio, staying informed about economic trends, and being willing to make adjustments as needed are essential habits for long-term financial resilience. In recent years, some investors have turned to alternative assets, such as cryptocurrencies, as a potential hedge against inflation. The argument is that digital currencies like Bitcoin have a fixed supply, making them immune to the inflationary effects of central bank money creation. While cryptocurrencies are highly speculative and volatile, and their long-term inflation hedging capabilities remain unproven, some investors allocate a small portion of their portfolios to these assets as a form of diversification. Another emerging trend is investing in businesses or startups that are well positioned to thrive in inflationary environments. Companies that provide essential goods and services, possess strong pricing power, or operate in industries with high barriers to entry are more likely to succeed when input costs rise. Direct investments in such businesses, whether through private equity, venture capital, or crowdfunding platforms, can offer attractive returns, albeit with higher risks. For those with a global perspective, international diversification can also help mitigate inflation risk. Inflation rates vary widely across countries, and investing in economies with stable currencies, robust growth prospects, or lower inflation can provide a buffer against domestic price increases. Global ETFs and mutual funds make it easier than ever to access international markets and diversify your exposure. Insurance is another consideration. Certain types of insurance, such as long-term care or health insurance, may become more expensive as inflation rises. Reviewing your coverage regularly and considering policies with inflation protection riders can help ensure that your benefits keep pace with rising costs. It's also worth noting the psychological aspects of inflation. During periods of rapid price increases, panic and herd behavior can lead to poor financial decisions. Maintaining a disciplined approach, focusing on long-term goals, and avoiding impulsive reactions to short-term market movements are critical to preserving wealth and achieving financial security. Estate planning should not be overlooked. Inflation can affect the real value of inheritances and the effectiveness of your estate plan. Regularly updating your will, trusts, and beneficiary designations to account for inflation and changing asset values ensures that your legacy is preserved for future generations. Finally, cultivating a mindset of adaptability and continuous learning is perhaps the most valuable asset in an inflationary world. Economic conditions are always evolving, and the strategies that work today may need to be adjusted tomorrow. By staying informed, seeking professional advice when necessary, and remaining proactive in managing your finances, you can not only protect your money from inflation, but also position yourself to thrive regardless of the economic climate. In summary, protecting your money from inflation requires a multifaceted approach. Investing in inflation-resistant assets like stocks, real estate, and commodities, using inflation-protected securities, managing your liabilities strategically, optimizing your income and tax situation, practicing prudent budgeting, investing in yourself, and maintaining flexibility in your financial planning. By understanding the dynamics of inflation and implementing these strategies, you can preserve and grow your wealth, even as the value of money fluctuates over time. The goal is not merely to survive inflation, but to use it as an opportunity to strengthen your financial foundation and secure your future.